If you read the chapter, and in particular the what they call the preliminary distribution of partnership assets and the proposed schedule of liquidation, the way they do it there requires the accountant to create a new proposed schedule of liquidation each time there is a transaction. And so what most accountants do to avoid having to redo this schedule is create a pre-distribution plan that guides distribution of assets in the liquidation. And so what happens is the accountant produces at the start of the liquidation this single pre-distribution plan to serve as a guide for all future payments. Whenever cash becomes available, the plan indicates the appropriate recipients without drawing up this ever-changing proposed schedule of liquidation. The plan is developed by simulating a series of losses, each of which is just large enough to eliminate, one at a time, all of the partners' claims to partnership property. And so what it does is it recognizes the sensitivity of each individual partner's capital balance to their allocation, and based upon that ratio of their capital balance at the time of liquidation to their loss allocation percentage, what you can figure out from that is what maximum amount of loss each partner can absorb, which causes that partner's capital balance to be reduced to zero. And so you make these assumptions of losses that are going to, in a sequential series of losses, create losses such that each partner has at some point a zero balance. Okay, and so you take the most sensitive, the partner who is most sensitive to loss, he's going to go first, and then the next sensitive second, and so on and so forth. So we'll see an example of that here. And essentially what you do once you figure out these sequential series of losses that result in all partners' capital accounts being zero, then you work back in figuring out the distribution to give each partner. So let's go through this example. You've got Rubens, Smith, and Trice, who have an income and I assume loss sharing percentage. Even if it doesn't address loss, the UPA is going to make them share losses on that basis, 50, 20, 30, right? And notice they have no cash. All they have is non-cash assets of $221,000 book value. They have $100,000 of liability, and you see Rubens, Smith's, and Trice's capital balances on the date of liquidation. And so partnership capital is reported at a total of $121,000. That's the sum of all those capital accounts. Differing losses would reduce each partner's current capital balance to zero, because each has different amounts in their capital accounts And on top of that, they have different income sharing percentages. So for instance, Rubens only has 30,000 in his capital account, but in a loss situation, he would absorb 50% of a loss. And so ask yourself, what amount would cause Rubens' capital account to go to zero? Well, it would be exactly 60,000, right? Because in a $60,000 loss, Rubens would absorb 50% of the loss. Thus, he would be allocated 30,000 of that loss, meaning his capital account at that point would be zero. Now you have to figure out each partner's sensitivities to losses in each sequence, or each remaining, once you get past the first sequence, it's each remaining partner's sensitivity to losses. Okay? So here, as you can see, Rubens is the most sensitive to loss here. So that's the first loss that we're going to consider in this sequence, because again, in this sequence of losses, we have to get all partners' capital accounts down to zero. And you're going to take the most sensitive partner, the one that has the most sensitivity to loss, and that's going to be your assumed loss in this first sequence. And that's going to wipe out Rubens down to zero capital. Then at that point you can deal with the sensitivity of Smith and Trice in this next loss sequence, as we will see. All right, so first we determine the maximum loss each partner can absorb. We take the most sensitive first. So here, Rubens is the most sensitive, since it would take less of a loss to cause his capital balance to go to zero. And then we're going to run the numbers. So Rubens goes to zero if there is a $60,000 loss. Smith gets 20% of that. So after this assumed loss of 60,000, Smith's capital account would be 40,000 minus 12,000, or 28,000. And then Trice would have $33,000 capital balance. All right, once you have wiped out your first partner, you have to recalibrate the income sharing percentages. Now here it's 20% and 30%. Smith 20, Trice 30. And so what we have here left is a 40-60 split. In other words, Smith is 2/5, Trice is 3/5. That is a 40-60 split of the remaining losses between Smith and Trice. And so we're going to recalibrate using those percentages. And so if you notice, that's what we've done here. Now, where did we get this additional loss of $33,000. Well, we simply took each partner's capital account remaining after the first sequence of loss right here. What they had left was $28,000 and $33,000. We took Smith's $28,000 and divided that into 40%. And so the maximum amount of loss that Smith could absorb in order for his capital account to be zero, is $70,000. And Trice, we took his $33,000 divided into 60%, and so his maximum amount of loss that would resort in his capital account being zero is $55,000. So that's where you come up with this assumed $55,000 in this second sequence of losses. Okay? And so we allocate that assumed $55,000 loss on a 40%, 60% basis. So Trice's capital account's now to zero. It reduces Smith's capital account down to $6,000. So what do you have left to reduce? What kind of a loss would reduce Smith's capital account down to zero? Well, $6,000, because that's all you have left. So that's a real easy one, right? And so your pre-distribution plan simply is to communicate to everyone, creditors and the partners, how cash is going to be distributed, because these are assumed maximum losses. And so to the extent that the assumption is not correct, which is more than likely true that it's not correct, any cash that's gain can be distributed to, well, any excess cash can be distributed to the partners. And so how that's done is you work backwards. And so, of course, you have to pay your creditors first. So that was $100,000. Here, what they've assumed is that liquidation expenses would be $12,000. So, of course, that has to be paid out of proceeds of the sale of these non-cash assets. And so, you know, essentially what you have here is non-cash assets book value of $221,000. You've got a $12,000 estimated liquidation expense. Anything above that received in the sale of these non-cash assets will be paid in reverse of how we calculated these estimated losses. And so after you've paid creditors and your liquidation expenses, the first $6,000 goes to Smith. The next $55,000 goes to Smith and Trice on a 40%, 60% split. So 22, 33, 22 to Smith, 33 to Trice, and then anything in excess of $61,000 after paying creditors and the liquidation expenses. So essentially any cash received after 112, 118, what? $173. Anything in excess of 173 is paid on the original split to Rubens, Smith, and Trice, 50, 20, 30 respectively. So this pre-distribution plan assumes maximum losses to get all your partners' accounts down to zero, and then you work backwards as far as cash distributions, any excess distribution of cash after paying creditors and the liquidation expenses goes per the pre-distribution plan in reverse. So pretty ingenious way of doing this.